Most people think we need thousands of dollars to start investing. Nope. You can start with just $100. Today, I'm breaking down the exact 4 levels of investing, from complete beginner to millionaire, and showing you which investments belong at each stage. By the end, you'll know exactly where you are and what to do next. As I go through each level, keep track of which one you're in. Then, comment your level at the end. Let's get right into it. Beginner level. Here is where everyone can start with just $100. Let's go. High-yield savings account. A high-yield savings account is like a regular savings account but pays more interest. Online banks like Ally or Marcus pay 4 to 5% right now because they don't waste money on fancy branches. Your money stays safe, insured up to $250,000 by the FDIC in US. You can take it out when needed, but some banks limit monthly withdrawals. Certificate of deposit. A certificate of deposit, also known as a CD, is like making a deal with the bank. You agree to keep your money locked for a set time, maybe 6 months or 2 years, and the bank gives you higher interest. The longer you lock it, the more you earn. Pulling money out early means paying a fee. CDs are insured by the FDIC, making them safe for short-term goals like saving for a trip or big purchase. Government bond. A government bond is basically a loan to the government. You borrow money and they pay you interest until they return your money at the end. It's one of the safest ways to invest because governments rarely fail to pay. Well, unless they do. US Treasury bonds are the classic example. Returns are lower than stocks but steady, making them great for safety and long-term stability. Index funds. Index funds let you buy small pieces of many companies all at once. They track indexes like the S&P 500, giving instant diversification and low fees. Instead of trying to guess which stock will win, you own a bit of everything. Over time, the market tends to rise. If you invested $10,000 in an S&P 500 index fund 10 years ago, you'd have roughly $34,000 today, giving around 13% annual return. They're simple, long-term investments that work best when you stay patient. Blue chip dividend stocks. Blue chip dividend stocks are shares of big, stable companies that pay dividends regularly. Think Apple, Coca-Cola, or Johnson & Johnson. You get both stock growth and regular income. They're seen as reliable, but they can still drop during market downturns. Many long-term investors like them for steady income and trust in the company's strength. If you've got $1,000 invested across these beginner options, congratulations, you're in the top 50% of American. Now let's get into the next level, investor level. Investments in this level are where you start building real momentum. Let's get in. Sector ETF. Sector ETF focus on one idea or industry like tech, energy, or clean energy. Instead of owning the whole market, they invest in companies tied to that idea. A tech ETF, for example, might include Apple, Microsoft, and Nvidia. These funds let investors target areas they believe will grow faster than average. But they're riskier because they're less diversified. If that sector drops, the ETF can fall hard. I'm curious, which sector will you bet on these days? Let me know below. REITs, real estate investment trusts. A REIT is a company that owns or finances income-producing properties, like apartments, malls, or offices. Think of REITs like being a landlord without the 2 a.m. toilet repair calls. You own a slice of shopping malls, apartments, or office buildings, and companies manage everything while sending you dividend checks. U.S. law requires most REITs to pay at least 90% of their taxable income to shareholders, making them a favorite for steady income. They trade like stocks, but are affected by interest rates and property market trends. Corporate bonds, or ETF. Corporate bonds are loans you give to companies in exchange for interest payments and repayment later. Bond ETFs group many of these bonds into one fund you can trade easily. They offer stable income and usually safer than stocks, though risk depends on the company's credit rating. Higher yields usually mean higher risk. International or emerging market ETF. These ETFs invest in companies outside your home country. International ETFs focus on developed markets like Europe or Japan, while emerging market ETFs target faster-growing economies like India or Brazil. They add diversification but come with extra risks, such as currency changes, political instability, or weaker regulation. If you have mastered those investments in this level, you're already ahead of 80% of people. Pause here for a second. If you're still with me, you're serious about this. Expert level is where things get exciting and risky. Which level are you at so far? Drop a comment. Now let's go to the next level. Welcome to expert level. Pay attention here, because this is where most beginners get burned. But if done right, it can boost your growth. Let's get in. Options trading. Options trading uses contracts that give you the right, not the obligation, to buy or sell a stock at a set price before a certain date. There are two main types: calls, bet the price will rise, and puts, bet it will fall. Here's the truth about options. I've seen people turn $1,000 into $10,000 in a week, and I've seen them lose it all the next week. You're betting on stock price movements with a deadline, and time literally works against you every single day. Master this or avoid it. There's no middle ground. The rewards can be big, but so can the losses, especially without knowing how leverage and time decay work. Technical trading. Technical trading relies on charts and indicators to predict price moves. Traders study patterns, volume, and trends instead of company details. Common tools include moving averages, RSI, and MACD. The goal is to find good entry and exit points for short-term trades. Success needs timing, discipline, and risk control. It can fail when markets move fast due to news or panic. Ever tried chart patterns or indicators like RSI or MACD? Share your experience below. Real estate rentals and flipping. Investing in real estate can mean renting or flipping. Rentals bring regular income from tenants and long-term value growth. Flipping means buying cheap properties, fixing them up, and selling for profit. Rentals offer steady returns, while flipping can be faster but riskier depending on market timing and costs. Futures, commodities, forex. Futures are deals to buy or sell assets like oil, gold, or currencies at a fixed price on a future date. Commodities trading focuses on raw materials, and forex trades currency pairs like dollar to euro. These markets are highly active but very volatile. They're often used by pros or institutions for hedging or short-term speculation. Algorithmic or quant trading. Algo trading uses computer programs to make trades automatically based on math models. These systems analyze data and trends much faster than people. They remove emotion but need strong coding, data, and risk management. Big hedge funds use them to profit from small, quick price changes. If you've mastered these expert investments, you're already ahead of 90% of people. Now let's go to the final level, master level. Investments in this level is where you can build your empire. Let's get in. Venture capital or private equity funds. Venture capital and private equity funds invest in private companies that are not traded on stock markets. Venture capital focuses on startups with big growth potential, usually tech nowadays. Private equity targets older companies that need restructuring or buyouts. Investors make money when these firms are sold or go public. The rewards can be huge, but so are the risks, and deep research is essential. Angel investing. Angel investing means giving early funding to startups for a share of ownership. Angels are often wealthy individuals who invest before venture capital firms step in. Angels often mentor founders, offering advice and business connections too. Remember when Uber was just an idea? Early angel investors turned $25,000 into millions. But for every Uber, there are 50 startups go to zero. You're not just investing money, you're betting on founders before anyone else believes in them. If you could invest in any startup idea right now, what industry would it be in? AI? Health? Let us know below. Real estate development and syndication. Real estate development means buying land, planning projects, and building properties to sell or rent. Syndication lets several investors pool money for large projects, like apartment buildings, managed by a sponsor. Profits come from rent and the rising value of property, but risks include delays, cost overruns, and market drops. Strong project management can make a big difference. Creating investment funds or holding companies. This strategy means open a company or fund to manage many investments under one roof. A holding company owns shares in other businesses or assets, giving control and legal protection. An investment fund collects money from investors to buy stocks, real estate, or startups. These setups offer tax benefits, professional management, and room to grow, but they need strong legal, financial, and regulatory knowledge. Acquiring or building businesses. This method focuses on owning real businesses instead of passive assets. Investors can buy existing companies or start new ones to earn profits and build value. It offers control, scalability, and high potential returns, but requires skill, capital, and effort. Many wealthy people grow their wealth by reinvesting profits into new ventures. Cross-asset hedging and macro hedge funds. Cross-asset hedging spreads investments across stocks, bonds, commodities, and currencies to reduce risk. Macro hedge funds use this to protect capital when global markets shift. They study economic trends, interest rates, and politics to balance their bets. It's mainly used by large institutions to stay safe while still earning returns. Now tell me which level you're at so far. Drop your level below. Hit the like if this video helps. And subscribe for more. Thanks for watching, and see you in the next one.